So the topic for today is time value of money. I'll quickly give you a briefing on what we are going to do in this particular discussion, or as to the basics of time value of money. Okay, so that everyone is comfortable around what is going to happen. Okay, so the first thing that you have to understand is whenever we are talking about time value of money, we are talking about money being transferred. Okay, money being transferred from present to future, or maybe future to present. Okay, so basically we are talking about how the value of money is supposed to change. Okay, how the value of money is supposed to change if it moves from us, from a particular date to another date. Okay, from present to the future, or maybe from the future to present, right? And whenever that happens, whenever time period changes, the value of money is also going to change, right? So that is what we are going to discuss today. So in order to understand time value of money, the first thing that you need to address is, you have to understand that when you take up a financial calculator, what are the terms that you're going to look at. Okay, so the first one is going to be, I'll just write down all of them. Okay, so one is future value, right, which is in short denoted as FV, right? So these are the notations that you can say. Then another one is present value. Yes. Then that is denoted as PV. Then the next important term would be, yes, I would want, you to comment on these things. Yes, everyone. Yes, number of periods. That is again important. So that is your time period, right? Which is, in calculators, you can see it as N, or in Excel, it can be denoted as N per. Okay, that is a number of periods. Yes. Then another thing is rate, right? So the rate of interest, okay, the discount rate. So that is something that we can mention as interest, okay, or we also call it as yield. Okay, we also call it as, when we are dealing with fixed income instruments, we use the word yield. So interest oblique yield, that is important for you. And yes, the last one is that you mentioned, that is PMT or payments. Okay, so that these are your annuity amounts. Okay, so which is represented as PMT, payments. Okay, what is annuity? Yes, this is just basic warming up that is going on. Yes, what is annuity? Annuity is fixed income. Okay, so that can be fixed cash flows that you're receiving on a periodic basis, amount paid in regular intervals, right? Yes, that is also fine. Yes, so the keyword would be that you are first receiving equal, either receiving or you are paying. Okay, this has to be equal cash flows, and that has to be at, equal intervals. Okay, so if it is every month, if it is every week, if it is every day, okay, but the intervals are predetermined. Okay, so that is what is annuity. Fine. So I hope these are the terms that you are aware of, that you are comfortable with. Future value, what will be the value of a specific sum of money in the future? Present value, what is the value of that amount as on today? Time period, for what's your period in which you want to move. Okay, so it can be 1 year, 2 year, 3 months, 6 months. Okay, whatever be the time period for which you are concerned about. Okay, so for which we want to understand how the time value of money changes. And rate of interest is your discounting rate or your compounding rate, with the help of which you are going to find the future values or maybe the present values. Okay, I hope that is clear. So, and when you're dealing with any problem on time value of money, okay, no matter what, let me give you the magical workaround with time value of money problems. Okay, it's not magical, it's quite basic, but don't get feared with any question. Okay, a time value of money question can be very, very long. Okay, but the ultimate picture is that what are you looking for? Okay, so whenever you are working with a problem on time value of money, just try to find out, what do I need to find in this particular problem? Okay, so what is the ultimate value, the outcome that we are looking for? Okay, so it can be your future value, it can be your present value. I'll give you a lot of examples. Okay, but first I'm just telling you the crux of it. Okay, so whatever is your outcome, you have to first determine it. And the thing is that if you know any three, if you know any three variables out of these five, then you will be able to find the fourth one. Okay, because one can be optional. Any one of them can be optional. It is not mandatory that in every time value of money problem you will find all the five variables. Okay, but at least there will be four variables. At least there will be four variables. Okay, and out of them, I'm telling you, I'm mentioning here that you need any three of them. Okay, so if you have future value, if you have present value, if you have time period, then you will be able to calculate the rate of interest, right? So, and similarly, if you have any three, okay, it can be any combination, and then you will be able to find the fourth one. And if you have this logic clear in your mind, you will be able to crack any problem on time value of money. Okay. I'll restrict myself to pure English today because we have participants running in from, beyond the borders as well. So I hope that is okay with all of you. Fine. So let me now tell you the link, the connection, the relationship between these variables. So you can think of as, let's say, the future value formula, right? I think you all have used it already, right? We know that future value of a sum of money would be the present value, okay, whatever we have had as on today, times 1 plus the rate of interest, okay, so the rate that we're talking about here, okay, to the power n, right? So that is the relationship between these variables. Okay, for annuity we'll have to look at it on a specific basis, but among others, this is how the relationship is going to look like. Fine. So if I tell you in this very simple example that the present value is, let's say, 100 as on today. Okay, so let me write down these variables here. So we have $100, today, and we want to invest it, let's say, for a period of 2 years. Let me just keep them aside. And the rate of return is, let's say, 5%. Okay, and there is no annuity, so there is no question of annuity. It is a one-time, one single investment. So if you're required to find the future value of money, how can you do that? We will be using this formula. Okay, give an equal sign. What is the present value? It is 100 multiply with 1 plus the rate of return that is specified as 5%, right? And that will grow for a period of 2 years, right? And that will give you the answer as 110.25, which is nothing but your final value. Okay, future value. Fine. I hope this is very basic. You are every one of you is able to understand what's going on. Yes. Amit, this is not DCF. DCF is something, the end of this. This is just the beginning of time value of money. Okay. Fine. So now let me talk about some important terms that you have to be very, very clear about. The first thing is, that I want to address is your rate. What is this rate of interest? Rate of interest is what you get, if I just take an example, let's say you have 1 lakh rupees or, $100 to be invested as on today. Okay. So you have $100, $100,000 or 100 lakh rupees to be invested. And you can invest it in, let's say, a fixed deposit at your bank, right? So in return, you are going to get something. You will be getting something in return. Let's say the return that you will be making is 5%. So this is your interest that you're getting. And let's say you have another opportunity. Either you can keep it in a bank account or you can start your business. You can start a startup. You can get into your entrepreneurial journey using this same amount of money. So now I have a very basic question to all of you. If you're doing business, what is the expected rate of return that you will at least have from this business? How much return, how much rate you want to earn at least out of this business? Yes, everyone? Mr. Said says 30%, Asutosh says 10%, Priya says 5%, Mrinal says higher than bank FD, Vikram says it should be 5% plus the risk factor. Okay, so yes. Well, the question was at least. So when I say at least, it should at least be 5%, right? And when I say what should be your expected rate of return, so of course it has to be more than 5% because FD was a relatively, no risk game or a very less risky investment. But when you are getting into a business, you are supposed to earn something more than that because you are assuming higher risk in the second scenario. So it has to be 5% plus the risk premium that is in this particular business, okay, depending upon the nature of the business. So this, but try to understand what is this 5%. This 5%, how did you get this initial value of 5%? That 5% is your opportunity cost, right? So that means what is opportunity cost? The benefit that you are foregoing, that you're losing, and that is your next best alternative, right? So if you're not investing into your business, you could have easily earned this 5% by putting this money into a bank account, right? So that gives you the opportunity cost of investing into this business. And if you want to arrive at the required rate of return from this business, then that is going to be even higher than that, because the risk profile is different in both these scenarios. Okay. So while discussing this very basic example, I have introduced you to some terms here, right? Interest rate, opportunity cost, required rate of return, and let me also mention here, discount rate. What is the difference between all these terms? Anyone can tell me? What is the distinction or the difference between all these terms? The answer is, these terms are nothing but the name of one and the same thing. Okay. So basically, what is your interest rate becomes your opportunity cost. This opportunity cost becomes your required rate of return. And if you use this required rate of return to transfer money from present, from future to present, then it will be termed as discounted. Okay, so basically, these are different interpretations of the same term, that is interest rate. Got the bigger picture? Yes, everyone? Fine. Next, I have a question for you. Try to guess this and try to answer this. I'm writing a statement that real rate of return is equal to risk-free rate. You can mention, the task is you have to mention whether the statement is correct or incorrect as per your understanding. You have to mention whether it is correct or incorrect. The answer is quite mixed here. Some say correct, some say incorrect. Real rate of return is the reward that you receive to defer current consumption. Okay. Correct, as this will be minimum. I guess no. So quite of a guesswork going on. Yes. So let me tell you now. Okay, I got it. I got it that there is too much of confusion going on here. So let me address that confusion now. Just now we have talked about two components of this rate of return, right? We mentioned about 5% plus, something risk premium. So that means the thing is that this interest rate, let me just catch up to one single term, that is this interest rate. This is composed of a few elements, right? This is divided into a few elements. So what are the elements into it? If you would understand that, you will be able to better, answer this question. So what are the components of an interest rate? The first thing is, now you mentioned here risk-free rate, right? But even before risk-free rate, there comes something. Okay, so basically real. What is the word real related to? The word real relates to inflation. Okay, and risk-free rate can also be real or nominal, right? So that is again a different story altogether, right? I think you all have heard of this real GDP, nominal GDP, right? If you have learned some basic economics, okay, in your school, college days. So then this real and nominal you must have been introduced to, okay? So what is real and what is nominal? Okay, as per, if you remember the term, that is as per, that is known as Fisher's effect, okay? So he was the guy, right? Anyone heard of this? Fisher's effect? That is what we learned in economics. So according to him, nominal is equal to what you are getting in real terms, okay, your real rate of return, whatever you are getting, plus the expected inflation, okay? So that means anything that is devoid of inflation, anything that is net of inflation before considering the effect of inflation, that is considered as real, okay? That is considered as real. So even if we talk about something as risk-free rate, okay, I'll give you examples for that. What is a risk-free rate? Something which we consider risk-free. Even within that, we can divide this into two components, whether it is including the effect of inflation or whether it is excluding the effect of inflation. Okay, so this can also be now divided into two parts. One can be your real risk-free rate. That is what you're actually supposed to get. Okay, the minimum rate that you're supposed to get. That is your real risk-free rate. That is your first component. And now this second component will be that of inflation premium. Okay, so that is what you will expect. Okay, because of inflation. That is not because of that is a component of risk-free rate. No, that is because of inflation. Okay, so we can further break down risk-free rate of return into two parts: real risk-free rate and inflation. Okay, and now what you see here, this 5%. Okay, so this 5% has been broken down into two parts, and the second element is risk premium, right? So that is going to relate to, that can be broken down into further three elements. Okay, so risk premium, it includes the risk related to an investment, right? So what is the risk in any investment? The first risk is related to default risk. Okay, so what is default risk? That you are not going to get your money back. Okay, you will not get your money back. That is the risk of default, right? So that is there in any investment. The next risk is liquidity risk. The next risk is liquidity risk. What is liquidity risk? That there are not enough market. Okay, market means there are not enough buyers and sellers in the market so that you will be able to readily and very easily sell your investment. Okay, so that means the risk of getting stuck with your investment, that is the risk of liquidity, right? And the third element of the risk premium would be maturity risk. Okay, so these are terms you should be aware of and you should be comfortable with. Maturity risk is more, you will be able to get more understanding when you learn about fixed income instruments in details. Okay, there is what we introduce a term called duration, which is a measure that measures maturity risk. But in simple words, what I can tell you is maturity risk is, you tell me, if I am going to hold an investment for 2 years and another one I'm going to hold for 10 years. Which one is more risky? I have not told you what instrument it is, what is the rate of return, anything, but I've just mentioned two time periods in front of you. Can you tell me which one is going to be more risky? Well, majority says 10 years, but there are some who are also saying 2 years as well. The answer is obviously 10 years, right? If you are going to get your money early, that is quickly, then that means there is lower risk because there is not much uncertainty, right? So if I tell you that I'll pay you, you lend me some money and I tell you that I'll pay you tomorrow. And instead of that, I tell you that I'll pay you after 1 month. So which one seems to be more risky? That after 1 month, who knows when that 1 month is going to come, right? But if I tell you tomorrow, at least you can, you can start calling me up right away, right? So there is less risk involved in that, right? So the lesser the duration, the lesser is the maturity risk. Okay. So I hope you got the picture. That is your maturity risk. Now, whether you have understood this explanation or not, let me test that out. I will tell you some examples, okay, some cases, some investments, and you have to tell me, how much return you should be expecting out of it. Let's say we can have some example, some fixed thing here. Let's say 5% is the inflation that we are facing. Okay, so that is what we are going to use in all the scenarios. Now, if I ask you, this is the investment, and this is the rate of return that you are expecting. So the first thing is that it's a government bond, and specifically, let me mention it's a sovereign bond. Okay, that means it's a government security. It's a government security. So what will be your expectation from this particular investment? Yes, at least what you will be expecting from this investment. You are saying risk-free rate. So how will you compute that risk-free rate? Yes, some are saying 5, some are saying it should be more than 5, right? So that means it obviously has to offer me, it has to beat the inflation. And at the same time, you are going to include something, okay, beyond that. So that is what we are talking about here. That is your real risk-free rate of return, okay? So that means, let's say the breakup is government is offering me 2%. Government is offering me 2% as real risk-free rate, okay? That is for investing into this security, okay? That is what you earn. And the remaining 5% is just your inflation premium. And the total what you see is 7%. The total that you see is 7%. Okay, so now you understand. Now you understand the breakup of interest rate, even if it is risk-free rate, even if it is risk-free rate. Yes. So now you will be able to answer this question with more confidence. Now, when I say that real rate of return is equal to risk-free rate, you can counter me and tell that in this case, the real rate of return is just 2%, right? It is just 2%. But if you talk about risk-free rate, that can be 7%. That can be 7%. Yes. So that is what you get even on a risk-free security like government bond. Now let me take you to an FD with a bank. So now you tell me what you will expect from this particular investment. What will you expect from this particular investment? Given that now this should be in relation to the government security. If government is paying me 7%, then what will you expect from an FD with a bank? That is what you have to answer. You don't necessarily have to give a specific rate, but you have to tell me below 7%, more than 7%, equal to 7%. If you can answer that, that would be fine. All right. So there are people who are mentioning that it can be below 7% as well. So first, let me look at that option. Okay, that is, let me also give you tips for the exams as well. Okay, so if you're sitting for CFA level 1, whenever you are dealing with options, okay, so you have option A, option B, option C, and you are not able to figure out. So just look at a particular specific option and then try to figure out why this can be possible or this cannot be possible. Try to rule out the options in front of you. Okay, so if you're not able to get the right answer, try to rule out the wrong answers. Okay, and that that helps you to lead to the correct answer. Okay, so that is how you should be dealing with questions in your exams. So coming back to the question, my question is whether the FD rate should be equal to the government security interest rate, or it should be higher than that, it should be lower than that, right? So whether it should be higher, equal, or lower, right? So first, let me look at the third option, that it can be lower than government security. In that case, you tell me which one is more safer. Government securities, a sovereign government bond issued, issued by the sovereign government, or a bank which is allowing you to invest into a particular instrument. Which one is more safe? So here you are saying that government is safer than a bank, right? And I hope you all understand that return is something that you are going to weigh in response to the risk involved into a particular security, right? So what return you will be expecting from an instrument depends upon the risk that is involved in that instrument, right? So if government is more safe than bank, then of course I am okay with a lower return with the government, but I will definitely be asking for a higher return from the bank, right? I hope that is clear. And let me also tell you that why bank is more risky. Because out of these two, who has the right to print money? Can banks print money? Can banks print money? The answer is no. They can only borrow from the central bank, right? They can circulate money, but they cannot print money, right? So it is only the government which has the right to print money, right? So that means it is very unlikely that the government is going to default on its bonds, right? Because yes, that can have different repercussions, but at least it can print as much money as it wants, and it can without defaulting on its instruments, it can pay back to its investors. But when it comes to a bank, it will have to ultimately borrow from other players. Okay, it can be central bank, it can be from other banks. Okay, it can be from different investors, but ultimately it cannot print money. So that is why the risk involved with a bank is definitely going to be higher than the government security. So that means this particular investment should offer me at least 2%, right? At least 2%. Then you will also be looking for the inflation premium. It needs to beat the inflation. And then, yes, there is some default risk as well, right? So there will be point number one, point number two, as well as point number three as well. Okay, so considering that FD is almost liquid, or let me just combine the remaining three elements into just one single term by the name of risk premium. Okay, by the name of risk premium. And this risk premium is going to be, let's say, it is not higher, of course. In case of a bank, it is not going to be very high. So let's say very basic as like 0.25%. So even if you are getting 7.25 or maybe 7.5, okay, so that is something you should be okay with. Got the picture? Yes, fine. Next, let's say if I tell you that you are giving a loan to Mr. Let's say Ratan Tata, okay, or let's say Mr. Warren Buffett. Now, what will be the kind of return that you'll be expecting from this particular lending, from this particular investment? Is it safer than bank? Is it riskier than bank? If yes, what you'll be expecting? Of course, this will, the pattern will continue as, the same pattern again, but this is going to be, let's say, even more than that. So let's say it's going to be 1% more than that. Okay. So you will, you believe them that these are very credible people. They are not going to default. They have a very good reputation, right? So you have all that knowledge. So considering that, okay, so you might lend them at 8% or even 9%. Okay. So whatever be the case. Now, if I just change the person here, let's say I change here to Mr. Malia. Okay. So for those who don't know, he's a loan defaulter. Yes. So in that case, what you'll be expecting? Is it equal to Mr. what you are, at the same rate that you are giving out to Mr. Ratan Tata, or is it going to be different? Brunel is clear. I'm not going to lend. So that technically means that you are going to lend him at instead of 1%, we can mention here infinity, right? So you have to you're going to lend him at that kind of a rate, which does not exist. Okay, so that is why it is going to give you an error, right? So I hope we are okay with that. So, so I hope you are able to understand, right? So what interest, what interest rate comprises of. Let me now even go further to, let's say, equity investment. Okay, any equity investment, which is, let's say, blue chip stock. Okay, which is a blue chip stock. So what will be your expectation? Now, Mr. Malia's case is not comparable. So if you can look at these other cases here, and now just tell me in relative terms, how much will you be expecting from a company which is a blue chip company? Mr. Sayed says 7 to 8%. So that means you are okay between debt lending and equity investments. You consider them almost equal. There is a risk involved in the nature of the asset as well, right? So that was a lending, right? That was debt. So fixed income instruments are not volatile. There is a fixed cash flow that you're supposed to receive, if at all you're going to receive it, right? So when there is certainty, your risk premium will be lower, right? But in case of equity investments, there is no certainty with respect to the returns. So of course, it is going to be more risky than all these investments, right? So the combination can be, let's say, of course, you need the real rate of return. Then you need the inflation premium as well. And then on top of it, okay, so if you were charging, let's say, 1% on fixed income instruments with, let's say, A-rated, double A-rated, triple A-rated instruments. So you are going to, of course, charge more than that. Okay, so it can be, let's say, 4% in this case, right? So you will expect around 10 to 11%, even if it is a, blue chip stock. Okay, and now if I change the situation to a, small cap or a micro cap stock. So that means these are companies which are yet to grow and yet to show their potential into the markets. So what you'll be expecting out of these companies? Around 20%, 35 to 40%. Okay, so that would be very, very high. Okay, nonetheless, I hope you got the bigger picture, right? So that is what I wanted to convey. So if you are, asking 4% from equity, so in that case, of course, it will also depend upon industry and the historicals of the company. There are a lot of factors that you're going to look at, what other players in this industry are giving you. But, I hope you got the picture. I hope you got the bigger picture there, right? So that is what an interest rate tells you, right? So that means now when you look at an interest rate, you don't just look at a number. You are now able to look behind that number, that what it is comprising of, right? That what it is offering you. Yes, everyone? You will have your expectations right. You will be able to compute the required rate of return with more clarity. Yes? Great. All right. So now let's quickly do some problems around it, okay, so that you get more comfortable. So if I tell you, let's say we are going to invest, we don't know how much we are going to invest, but we are going to make an investment every year. And the thing is that I need to accumulate, let's say, 5 crore rupees. Okay, so that would be 500 lakhs. Okay, so let me just write down 500 here. Okay, you can give me the answer in lakhs. Okay, so if I need to accumulate 500 in a period of 5 years. Okay, so that is at the end of year 5. So yes, will you be able to give me the answer? Yes, this is not something you are just going to watch. Okay, open up an Excel sheet, open up your financial calculator, and then you are supposed to answer these questions. Give us the rate of return. Okay, I missed out on the rate of return. Thank you for that. 10% per annum. Okay. Yes, everyone. I want each one of you to answer. Yes, this is not something that you can say that I'll do it later. The question is how much I need to invest per annum. That means every year. Okay, so you have to be very clear what you are looking for, what you are computing. Investing per annum, that means you are investing every year. So now you tell me, what are you computing? What are you computing out of these 5 variables? Yes? What are you computing here? Yes, that is where you people get confused. It's a recurring amount, right? It's a recurring amount. And it's going to occur at every regular interval, right? So don't you think it fits in the definition of annuity rather than present value? Because present value is the value of what you are going to get in the future, right? So you're going to get 500 in the future. So you're simply computing what you're going to, what should be the value of that as on today. But you are not investing a lump sum amount here. If the question was a lump sum amount, then you could have computed present value, right? So it is not a tricky question. It's a very simple, basic question of time value of money, right? I've not even got started with the problems, right? The intensity can get to very greater extents for those who understand that to what extent I can get into. Yes, we are just getting started. Okay, so I have answers coming in. We have answer as 310. We have 81.90 something. So these are the two answers that I've got till now, 311 as well. 8,33,000. Okay, so 81 point something, if you mention that would be okay. Now, for those who are mentioning 300 something, that is, of course, you are computing present value, and that is what not we are looking for. We are not looking for present value here. Please try to understand the question very clearly. Okay, read the question very clearly. And let me tell you, when you're sitting in exams, okay, let's say you're sitting for CFA level 1, okay, may attempt, and this can be one of your options. They will mention in answer A, it is 81.9, and in case of B, they can definitely mention 310 point something. And as soon as you compute it in your calculator, you simply select B and you move on. That is how you are tricked in these exams. Okay. So you don't have to do that. So now I'll be quickly jumping onto the solution here. What is the amount that we have to accumulate? That is 500, right? So simply fill in the variables here. Present value, there is no question of present value. I'm not investing any amount upfront. I'm just investing here as a systematic investment every year. Okay. So, and what is the number of periods? That is 5. What is the rate of return we are expected to generate? That is 10%. So now we can compute the annuity amount here. That is PMT. Okay, on your financial calculator as well, it is going to be PMT. Now simply specify the rate of return, that is 10%. Number of periods is 5. Present value is 0 here. Future value is 500. And then what you get is 81.90. For those who have given the correct answer, great. Okay. So I hope this was pretty easy. Yeah, this is not exactly 81.9. It is going to expand further, but whatever be the amount. Okay. 8987. Okay. Now, let me carry forward. Let me build some questions around this only. Next question. Okay. Next question. If I want uh, to pay this exactly the same amount, okay, I want to pay this 81.89. Okay, if you have computed in on your Excel sheet, you can consider the full amount. Okay, I'm just writing here in short, 81.89. So if I want to pay this much of money as an installment. Now that is going to be not an EMI, but an annual installment. Okay, I'm supposed to pay out. This time I'm not investing. This time I'm taking a loan. And my thing is that I want to, if I can give out this much, amount, if I'm ready to pay this much as my installment for, of course, the next 5 years. Okay, let us consider the same duration here. Now the thing is, how much loan can I get? I have basically reverse engineered the question. I have given you the installment that we'll be paying every year for the next 5 years. Interest rate is, by default 10%. So it's fine if I'm not writing it again and again. Okay. The question is, how much loan can I get, or how much loan I am getting today so that I'll be making payments of 81.89? Yes. $310.46 something. So that means the PV that you were computing in the previous example is the answer for this question as well, right? For those who understood the question very well, they could have answered it without even looking at the options, without even touching their calculator, because that is, I believe, many of you have already computed in the previous example. Okay, so 310 point something is what you are saying. Don't say direct 300, because 300 is not the accurate answer. When you are working with calculators, you have to be precise. Okay. So how do you arrive at this calculation? Okay, simply keep on repeating these uh, variables, right? So what you are having, do you have the future value with you? Do you have the future value? There is no future value in this case, right? Present value is what we have to compute. So this will be my variable that I'm looking for, right? Then number of periods is 5, rate is 10%, PMT is this much, right? So now you simply specify this in your PV, right? Present value, specify the rate here, specify number of periods, PMT is this much. Okay, future value is 0, so I can simply close that, and that gives me 310.46, and that is the exact answer. All right, everyone. Great. Let me carry forward and introduce something here. Let's say you are, uh, just give me a second. Without timetable, I think you will be able to understand this. Let's say I want to, instead of getting 500 at the end of year 5, I want, I can just repeat the same question. How much I need to invest every year? If I need, not 500 at year 5, but uh, let's say it can be, okay. Okay. So basically I've, done some calculation. I need 272.72, okay, at the end of year 4. And I need 220 at the end of year 6. Now I need your answer. Similar to the first question, some changes have been made to it. Do you want me to draw a timeline? For those who have understood, you can carry forward. Well, for time value of money, if you're ever stuck at any problem, you're not able to understand anything, the best way to solve them is using the timeline. Okay. So what we are doing is we are at 0 today, right? 1, 2, 3, 4, 5, 6, right? So at the end of 4th year, let me just write down 1, 2, 3, 4, 5, 6. At the end of 4 year, I will be getting 272.72. At the end of 6th year, I want 220. Okay. So now the question is how much I will be investing. Now this is going to, this is what you'll be investing for the next 5 years. Okay. This is what you'll be investing for the next 5 years. So that is invest every year for the next 5 years if I need 272 and 220. So basically what I've done is not much. Okay. What I've done is just change the, previous question. So earlier the question was, I needed 1, 2, 3, 4, 5. So earlier we needed 500 at the end of year 5. Okay. And for that we needed to invest 81.89, right? So, okay. So I'll explain you more, but first let me see your examples, your answers. Okay. Let me be very clear again. Please be very clear on the question that the investment amount is going to be the same for the next 5 years. That is not changing. That is an annuity. Okay. So your investment amount is not changing and you're investing this money for the next 5 years again. Yes. Once I tell you the answer, you will be able to see that this is nothing but just a variation of the first problem. Vikram, how can you make a mistake? We have already, I had a discussion on it. Ganesh, 87. Okay, so Vikram has again answered his new answer. Okay, fine. Whether that is correct or not, let me check out. Okay. So first of all, how many of you have not even understood the question? I have no idea what's going on here. Kishan has an answer of 44.67. Ganesh is 87. Vikram is 77. Omkar is 80 point something. 80.71. Okay. 41 point something. Okay. So there are so many answers coming in. I'll just repeat what we were doing. Okay. So first, let me explain you the problem. What are we doing here? Okay. What are we doing here? This time you are confused. This time you are confused because you have two amounts to reach, right? You have two amounts to reach, 220 and 272.72. So what are we supposed to fill in the future value? What are we supposed to fill? So that is the first question that is, I believe you are facing. The second problem, the second issue is the timelines do not match. The timelines do not match. I am supposed to invest for 5 years, but I'm going to withdraw. I'm going to withdraw my investments not at the end of 5 years, right? It is at the end of fourth year and at the end of sixth year. So that is where the confusion starts to build up. Yes. So let me now tell you the way to work around with these problems. The solution to this is always try to bring them on the same timeline. Okay. So if this is straightforward, that I have to invest for 5 years, don't touch this amount. But this is something that we're supposed to withdraw in different time periods. Why don't you bring them on a particular date? Why don't you bring this fourth year to fifth year and the sixth year investment withdrawal to fifth year? Can you bring this 272.72 to the end of fifth year? Yes. 272.72. If I want this money at the end of fifth year, then it will be how much? Vikram, dimag ka batti jala? Remember? Now, I'm talking to one person because that was a specific doubt which I have received from him. Okay, it's not that I'm not talking to others. So that would be 300, right? So basically this is a, round up amount. So it can be 299 point something. Okay, but it's fine. Ultimately you're getting 300, right? And this 220, which you're supposed to receive at the end of sixth year, if I want to receive it at the end of fifth year, it will be what? 220. You have to discount it, right? At the rate of 10% for a period of 1 year. So yes, tell me what is the answer for that? Of course, in 1 year, you will receive 20, right? So basically it will be 200. So at the end of fifth year, if I want to compute, ultimately you have to get 500 only, na? So isn't it the same question that I asked you in the first place? Isn't it the same question that I asked you in the first place? So the answer has to be 81.89. It cannot be different than that. Yes? It is the same question, just a different representation. How many of you could not figure it out? Yes. Any confusions, any doubts, and I'm open to it. Start raining your questions. So now the question is very simple, right? I need 500 at the end of fifth year. No investment as on today. Number of periods is this. This is 10%. And now I'll simply use the PMT formula, specify the rate and specify the number of periods, specify present value, specify this, and I get the final answer. What happened? Future value is this. Rate is this. Number of periods is this. Present value is 0. Future value is this. Just a second. Let me, why I'm doing all that, I can simply copy it, right? Yes, I think now it's solved. Okay, so here I had a formula actually. Yeah, fine. It's a twisted question. It's an intentionally twisted question. Yes, Mundal, definitely. Uh, yes, that is fine. The circular reference is now relieved. Can you explain it again? Yes, definitely. I'm happy to explain it again, even 5 more times. But first, let me tell you. Let me ask you that this question is the same as the first one. The only thing that changed here is I divided this 500 into two parts. One part we are supposed to receive in the fourth year, another part we are supposed to receive in sixth year. Okay. So that is what I've done here. And now the challenge was very simple, that you had to identify that how do I bring these amounts of money which are in different time periods into a single time zone, right? So the task for you was that my investments are for 5 years. I need to make my withdrawals if I were to invest. Okay, if I were to invest at the end of fourth year, at the end of fifth year, then what will be the amount? What will be the amount? So bring this fourth year withdrawal at the end of fifth year. It comes out to 300, right? It will compound for one more year. And this is at the end of sixth year. So we have brought it 1 year earlier. So it is going to be discounted for 1 year, right? And that ultimately comes to 500. And now when you invest this money, when you compute the payment amount, and now if you invest this money, you are absolutely going to get the same result. For those who do not trust the result, let me tell you that you are going to invest. Let me just write it down. What are you investing? You are investing this much, you are investing this much every year for the next 5 years, right? So now the question is, now we need to make the first withdrawal at the end of fourth year, right? So what is the amount that you have accumulated at the end of year four? What is the amount that you have accumulated at the end of year four? So we can compute that using future value formula, right? We are investing at a rate of 10%. Number of periods would be 4 now, okay? Because we are computing at the end of year 4, not year 5. That was just a way to work around with the problem. But actually, you are going to stick to your plan, okay? You are going to stick to your plan. So PMT is this much, okay? No present value. So at the end of the fourth year, you will be having 380 rupees or dollars, $1 million in your account. Now, what you are supposed to do, you are supposed to withdraw. You are supposed to withdraw how much out of it? 272.72, right? That is what I have worked out. 272.72 is what you are going to withdraw. So how much you are left with? How much you are left with at the end of year 4? You are left with, out of this, you have spent this much, so you are left with 107 at the end of year 4, right? But now this money will keep on growing. You have not exited the plan, right? So this money will keep on growing. So at the end of year 5, what will be the value of your investment? What will be the value of your investment at the end of year 5? It will grow, right? It will grow by 10%. Okay, right? Just for 1 year. So it will be 1.1. So it will become 118. Yes. Then your final, we had included only 4 years of installments into this amount here, right? So the fifth installment is yet to come. The fifth installment is yet to come. Yes. So that is again this amount that you have invested, right? So what is the total you are left with? Total you are left with amount available at year 5. So that will be this plus this, right? So that gives you ultimately 200. And now how much you are supposed to withdraw? Now you are supposed to withdraw this 200, right? That was our ultimate goal. That at the end of sixth year, I wanted how much? I wanted 220. So, sorry, I want 220, right? I want 220. So this is after 1 year. So what will be your amount at the end of year 6? At the end of year 6, that will again grow by 10%. That will again grow by 10%. So now at the end of year 6, you have 220. You're supposed to withdraw 220, and the amount that you'll be left with at the end of this will be 0. Yes, so there is some, decimal rounding of errors because I have, written here 272.72. That was a rounded number. If you put it properly, then that is going to give you the exact amount. So now, hence verified, hence proved that the plan that I have shown you is exactly correct. Yes, there is no mistakes. See you in the next one. All right. So, bye.